This is Kevin O'Brien with Handelsblatt Global. I'm here today with Steve Auth, the Chief Investment Officer of Federated Investors, one of the largest mutual fund companies in the United States, with over $300 billion under management. Mr. Auth, thanks for being with us today.
Thank you, Kevin.
We're about 3 weeks away from the U.S. election.
Is it that close?
It feels like it's tomorrow, but what is the market expecting to happen at this point?
I think the market's base case is a divided government. Most of the polls suggest that Clinton is likely to win the presidency and the Republicans are likely to hold the House, although by a slimmer margin than they've had. So that's kind of the happy outcome for the market, a divided government that basically doesn't change the status quo.
Does the market care whether Donald Trump or Hillary Clinton wins, or is the market agnostic?
I don't think the market's agnostic at all. I think in a divided outcome, the market's happiest. In a Democratic sweep, the market would get nervous because you'd have a tilt of the government to the left, further to the left. The healthcare sector would probably get hit pretty hard. The energy sector would get pretty hard. And people would be worried about economic growth under that scenario. The outcome we're more worried about is the possibility of some kind of divided government coming out of the election. I mean, some possibility that the Republicans lose enough seats that it's hard for them to form a unified opposition government, if you will, between, say, the Tea Party, Trump movement, and the remainder of the Republican Party. I think that's an outcome the market's not as focused on, but that's another possible outcome that would leave a lot of uncertainty yet to be resolved.
Under that scenario, why would that be a threat? If Hillary Clinton were to win big, why would it matter if the opposition was in a shambles?
Markets don't like uncertainty, Kevin. And in an environment where you don't know who's in charge in the House, it's hard to have a functioning government. You've got continuous budget resolutions to pass, debt ceilings to be lifted, et cetera. So you kind of jump from one crisis to the next. No one wants that outcome.
So in this election, the best possible outcome from a market perspective is a government in check, so to speak.
Yeah. Yeah, I think most people in the market think the less damage, the better. And a divided government's probably the best possible outcome. And that may be the likely outcome. But as you may know, we're relatively cautious right here. One, we think you got to get past the election. Two, we think earnings for next year are way too high. In our economic growth assumptions, we're assuming fairly slow growth in the U.S. again next year against a backdrop where the market's expectations of earnings are too high and valuations are pretty stretched. So even without the uncertainty around the election, we've been advising a certain level of caution going into the end of the year.
Given that concern about high valuations, would you buy equities before this election, or would you wait until after the dust clears?
Well, we're recommending people be 50% weighted in equity, so we're not running for the hills. But we're underweight neutral targets. We're telling people hold some dry powder, and certainly, to the extent you have some dry powder, wait for a post-election environment where either you get a restoration of certainty, if you will, or better market levels to buy back in.
Mr. Auth, thanks for being with us today.
Thank you, Kevin.